think it's probably universally true to say that most sophisticated professional investors understand that occasionally an investment will go wrong. And companies can fail, be wound up, however you want to put it, under circumstances where everybody knows that the entrepreneur has done the best they could, that for whatever reason, the market, competition, whatever, not everything works out. But if there's been transparency, openness, good communication, clarity around the efforts that have been made to recover the situation, etc., then even a kind of a negative investment experience doesn't leave a bad taste in either's mouth. But if there's a situation where perhaps the founder entrepreneur is keeping their cards close to their chest, they're very defensive, they don't share the efforts that they're taking to try and recover the situation, then it can become quite a poisonous relationship. So I'm trying to portray a picture that we're all in it together is a lot better than being defensive and guarded with information.
Absolutely. And I think that, once a board member said to me, and it was great advice, just get bad news out on the table as quickly as possible. And I think that there is a tendency to go hard, we want to just put our best foot forward. We want to have it all figured out. We want to be the superstars. We want everything to be going swimmingly. But I think the advantage in being open and honest and transparent with whatever the situation is those people around you do have your best interest at heart, and they want their money to succeed. So of course they're going to, do as much as they can to support you and give ideas and strategies. So I think sometimes it's just, we need to get out of the idea that we need to have everything figured out. That's the reason why we have a board or have shareholders around us to support us.
You're 100% right, Danielle. And the other thing that I would say is that it might feel like this has never happened to anybody else, but chances are, whatever the challenge is, it has. And if you think about OneVentures, I mean, look, I've kind of lost count, but our investment team is 15 or 18 people. And people that have had long careers, people who've had shorter careers, international careers, across a whole range of different verticals in the market, as entrepreneurs, as senior executives, as investors. So if you have a good investment partner, what you'll typically find is you may have a primary contact, but in firms like OneVentures, if we have a challenge with one of our portfolio companies, we'll share that with our team and we'll bring the collective wisdom to bear to help resolve that challenge. And I've seen that happen time and time again where, I certainly don't know everything, but if I look into the sort of brains trust at OneVentures, someone will probably have been through this before. And if they haven't, they'll know somebody else that they'll introduce me to. And together we can try and bring all of that experience to bear to try and facilitate a good outcome.
I love that. I think it's amazing. So talk to me about the landscape. So do you think that, and this is probably personal outside looking in, do you think that the capital raising landscape has changed over the last decade? I feel like, a decade plus ago, it was very much high growth users, no profit, show traction, spend all of your money, da, 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 da. And then most recently, where I've had conversations with founders, it's been very much need to show traction, need to be profitable, X, Y, Z. Do you think the landscape has changed? And do you think there's something that VCs are looking for in a business today?
Look, I absolutely think it's changed. And I think it's changed just in the last few years from sort of, if you sort of want to characterize it as sort of pre-pandemic, growth at any cost was really the mandate. So take a lot of money, grow really fast, we'll fix profitability another day. To, you may be investing in growth and we want to see, good growth metrics, but we also want to see a path to profit. So I think definitely that has changed in the last sort of few years. I also think the investment landscape in terms of product availability has changed. So if I just even think about our sort of 14 years at OneVentures, when we started, there was very little sort of seed stage funding. So that's why we started as an early stage investment fund. You fast forward sort of 4 years to when we launched our second fund, and there was very little growth. And then a couple of years later, Australia had hardly heard of venture credit or venture debt. So we launched a venture credit fund. So this is really just an example of how, there's no sort of one size fits all in the investment landscape anymore. So if you think about us, we have a growth product, a healthcare product, a venture credit product, and other firms similarly have a diversity of offerings. So I think, tying this back to your initial question, there are different products that suit different stages and different types of companies. So if you're looking for a mix of later stage equity and perhaps a little bit of venture credit, which is non-dilutive, you're probably going to be a firm that can demonstrate a pathway to profit sooner rather than later, or some way of generating free cash to be able to repay that loan. If you're a high growth, then you're looking for a different sort of an investment product. So I think that diversity is really exciting for the entrepreneurial ecosystem, and it also is exciting for investors to have access to a range of different products in the market.